EBIT, earnings before interest and tax. EBIT is a really common reference point, and you'll see it in other formulas in this video series that we use as the baseline metric when comparing to other elements. So for example, when we talk about return on capital, EBIT is the first number that we refer to. Why is EBIT so important? This, I believe, when you're looking at valuing a business, is the key number in that valuation. Because earnings replace earnings with profit. It's your profit before you pay any interest and you pay any tax. Look at those two factors. Firstly, interest. Your business might not have any interest in it. It might have some equipment finance interest in it. It might be loaded up to the hills with debt. But it doesn't necessarily make the business itself better or worse. If your business was bought out by the richest person in the world, they would most likely eliminate all the debt. You would no longer have any I in the EBIT equation. You wouldn't have any interest expense. Is your business any better as a result of that? No. Conversely, you might have a very successful business and whoever buys your business might need to take on debt to acquire it. The interest expense would go up. Again, is the business any better or worse? No, it's not. But you do need to be conscious of covering your interest expense through your earnings. If you ever have any banking covenants you need to meet, quite often an EBIT metric is used. You might need to create enough earnings to cover your interest 4 or 5 times to ensure you stay in the good graces of the bank. The second element is tax. You might have the best tax accountant in the world. You might be structured as a company, so you're guaranteed to pay tax. You might be structured as a trust or a partnership, and those vehicles generally don't pay tax. It's paid elsewhere within your family group. So again, if you're running as a company versus a trust or a partnership, your business isn't necessarily any better or worse as a result of that. It's just how you are set up. Hence, earnings before interest and tax is a really good way to understand the performance of your business relative to any other, while still capturing depreciation and amortization, which isn't included in EBITDA.